Now what I would like to do is introduce our speaker for today, Chip Harder. Chip is the Deputy Assistant Secretary for International Tax Affairs at the Department of the Treasury. In this capacity, he's responsible for basically international tax policy in the Office of Tax Policy at the Treasury Department, and it includes his involvement, his very close involvement in all the regulatory projects that we are all aware of. And as you know, there is many regulations, for example, 965, GILTI, BEAT, etc., that Chip is involved in. So he's very much involved in the regulatory process. He's also involved in representing the United States in bilateral and multilateral relations with other countries. And he works with the Secretary. He works with many other parts of the Treasury Department. And he works with the Hill on all these kinds of matters. So he's involved in both legislative and administrative guidance. He also serves as our representative of the United States around the world, particularly in dealings with the OECD. And of course, we don't live in a vacuum here in the United States. I know we feel that we are somewhat separate from the rest of the world, but we're really not. And with all the globalization, we do deal with the European countries, particularly the OECD and countries around the world. And so Chip is very much involved as our representative in all these matters. Before joining Treasury, Chip was a principal at PwC in Washington, D.C., concentrating in international transactional practice as well as financial products. And before that, he was a partner with Baker & McKenzie, both in Chicago and in Washington. Let us welcome Chip for his remarks.
I'd like to thank you, Eric, and the organizers of this conference for inviting me to address you here today. The timing of my appearance before you and the stature of this group makes this a great opportunity for me to update you on our progress in providing guidance implementing the international provisions of the Tax Cut and Jobs Act, and to share some observations with you about the rules that we are implementing. Writing regulations to implement the international provisions of the TCJA is a monumental task. Early on, the Treasury Department and the IRS decided that we would like to issue by year-end a fairly complete set of proposed regulations and to issue final regulations within 18 months of the legislation's date of enactment. I believe that it may well be an unprecedented effort to write such a substantial body of tax guidance in such a relatively short amount of time. The scope of the challenge necessarily limits what we can accomplish. What we are attempting is to build out the architecture of each of the major components of international tax reform in the proposed regulations. But we will not be able to address all of the details and all of the special situations. Our proposed regulations will not be perfect, but we want to get proposed regulations out as promptly as possible, even if imperfect, to give the profession as much opportunity as we can to comment and to help us improve our work. So how are we doing? We have 7 major guidance projects underway with respect to the main components of the international tax reform legislation. These are the guidance on the transition tax under Section 965, guidance on the global intangible low tax income regime under Section 951 Cap A, revisions to the foreign tax credit provisions, guidance on the base erosion avoidance tax, or BEAT, under Section 59 Cap A, implementing the anti-hybrid provisions of Section 250E and 267 Cap A, guidance on the deduction under Section 250 for the foreign derived intangible income and GILTI regimes, and 7th, revisions to the previously taxed income rules is made necessary by all the other legislation. In addition to these 7 major international tax reform packages, we have a number of smaller international projects, including implementing Section 864C8, as well as new PFIC insurance rules. We are also collaborating with our domestic colleagues in putting together a major regulation package under Section 163J. So the question is, when will these proposed regulations be coming out? The proposed regulations implementing the transition tax under Section 965 were released on August 1st, and the comment period for those regulations ends next Tuesday, I believe, on October 9th. We are committed to doing all we can to issue final regulations under Section 965 by year end, given that that is a 2017 tax liability with respect to calendar year CFCs. We have received very helpful comments, which we are considering as we work out final regulations. On October 1st, we released a notice to correct a couple of items in the proposed regulations identified by comments. One of these corrections is to cross-references used in the definition of cash equivalents to clarify that a short-term loan between CFCs that are owned by the same consolidated group will not be treated as a cash equivalent even if the CFCs are owned by different members of the consolidated group. The second correction extends the date for filing an election to make certain basis adjustments with respect to each deferred foreign income corporation and each E&P deficit foreign corporation to no sooner than 90 days after the Section 965 regulations are issued in final form. As the proposed regs came out, they had an election deadline prior to the finalization of regulations, and it was pointed out that that is inappropriate. We look forward to receiving more comments during the remaining comment period, which ends next Tuesday. We urge interested parties to get their comments in on a timely basis because we are working on a very short time frame to meet our year-end deadline. We also issued a proposed regulation package addressing the computation of a guilty inclusion. This package was released on the IRS website on September 13th. It's scheduled to be published in the Federal Register officially on October 10th, and the comment period for these guilty inclusion regulations will end on November 24th. We have started to receive comments, and we have been reading discussions in the tax press regarding these proposed regulations, including comments on the anti-abuse rule provided in proposed reg section 1.951-1E6. I will turn to that topic in a bit later. So those are the proposed regulations that we've gotten out so far. Next up, we have 4 major regulation packages where the drafting has been largely completed and the packages are moving through final approval process within IRS Chief Counsel and the Treasury. These 4 packages are the revisions to the foreign tax credit, the BEAT proposed regulations, the 163J proposed regulations, and the anti-hybrid proposed regulations. Taken together, these 4 packages total close to 1,000 pages. Once they have cleared the final approval process within the IRS and Treasury, they will be sent to the OMB for review. Clearing 4 such large packages in the same month is a substantial undertaking. But we are hoping to publish the first of these packages during the first week of November and the remaining 3 during the remainder of November. Following those 4 packages, will be packages implementing the foreign-derived intangible income regime, as well as a package revising the previously taxed income regime. We have an initial draft of the FDII regulation package, which is still going some editing and review. We are targeting sometime around the end of November or early December for publishing that package. The previously taxed income package is a technically challenging project that is still being drafted. We are unlikely to get a complete set of proposed regulations dealing with these issues out by year end. We are exploring, however, whether we can get guidance out on key issues, including certain guidance relating to the calculation of currency gains and losses under Section 986C by year end, given the importance of these issues to financial statements. Finally, there are some guidance packages not related to tax reform that we are working on hard and hope to get out by year end. The Treasury and IRS are working on proposed FATCA regulations that aim to reduce the burden on taxpayers. We are aware of the concerns about the withholding on gross proceeds that is scheduled to begin on January 1st, 2019. Our goal is to issue regulations by the end of the year that will relieve taxpayers of the burden of withholding on gross proceeds. The Treasury and IRS will also be issuing regulations to address concerns we have heard from the insurance industry about withholding on premiums for non-cash value insurance policies under FATCA. Finally, the Treasury and IRS intend to finalize the proposed FATCA sponsoring entity regulations in the near future. So that's what you can expect to see over the next few months. I do want to emphasize the point that I started with. Our priority has been to promptly get out to taxpayers in the profession proposed regulations that would lay the foundation for the new international tax regime so that we can get your input. Given the deadlines involved, the proposed regulations will be neither perfect nor comprehensive. They are proposed regulations, after all. Guidance needs to be and will be an iterative process in which your comments on the proposed regulations will provide a vital role in helping us make the final regulations better and more complete. Our requests for comments in the preambles to the proposed regulations are a sincere recognition that we may not have found the best answers to all the issues and that we need help crowdsourcing future or further improvements. I will observe that incredibly talented teams of professionals from within both IRS Chief Counsel's Office and Treasury's Office of Tax Policy have been working day and night to analyze the changes Congress made to the international tax rules and to draft the proposed regulations. I could not be prouder of their talent and their dedication. With the benefit of comments from taxpayers and tax professionals, and with the continuing dedication of the drafting teams, I am confident that we can get out regulations for all of those major packages within 18 months of the enactment of the TCJA. Having talked quite a bit about process issues, I'd like to share a few observations about the substance of the international tax reform provisions that we are being asked to implement. First, some aspects of international tax reform are quite challenging. Whereas foreign source income used to be subject to a single statutory rate of 35% for corporations, it can now be subject to tax at several statutory rates, including 21%, 15.5%, 10.5%, 8%, 0%, and various blends of those rates, and new rates will be phased in over time. We have new foreign tax credit limitation baskets, one for GILTI inclusions and one for branch income. Foreign tax credits can be subject to haircuts depending on the rate at which the underlying earnings were subjected to U.S. tax when included in the income of U.S. shareholders. Legislative history instructs that the foreign currency translation gains or losses under Section 986C are to be scaled to reflect the tax rates at which those earnings were subjected to U.S. tax when included in the income of U.S. shareholders. While old Section 902 has been repealed, it has been replaced in part by new Section 960B, which is at least as challenging. As we have drafted proposed regulations, we have erred on the side of trying to fully build out the regimes to reflect the logic of the statute. Some might observe that that approach has come at the cost of complexity. In the process of putting together final regulations, we will explore ways to reduce that complexity. We especially welcome comments on where and how we can do so. As we have been analyzing the new statutory provisions, we've been vigilant in looking for opportunities to reduce complexity and ease administrative burdens as a result of tax reform. You can expect to see some proposed changes to existing regulations in the near future that can be simplifications in light of the new statutory provisions. A second observation regarding the substance of the forthcoming guidance relates to the existence of some potential gaps in the statutory structure of the GILTI and Subpart F regimes that taxpayers may attempt to exploit to permanently avoid U.S. tax on significant amounts of CFC earnings to which it would not be appropriate to give territorial treatment. The three main issues appear to be, first, whether a Section 78 gross-up with respect to Section 965 inclusion from a fiscal year CFC is entitled to a Section 245 Cap A deduction. Second, relates to the different effective dates applicable to a fiscal year CFC for Section 951 Cap A on one hand and Section 245 Cap A on the other. And the third set of issues relates to the interaction of Section 951 A2B and Section 245 Cap A with respect to the current year earnings and profits when shares of a CFC are sold during the taxable year. This issue was highlighted in the New York State Bar Association comments on the GILTI legislation. We understand that the staff of the Joint Committee on Taxation is coordinating the drafting of provisions for inclusion in a technical corrections bill to address these issues. We are simultaneously considering what can be done through the possible issuance of regulations under Section 245 Cap A as a means of backstopping the GILTI and the Subpart F regimes. We believe that it is appropriate for Section 245 Cap A to give territorial treatment only for CFC earnings that are not attributable to tested income appropriately taxed under the GILTI regime and not attributable to Subpart F income appropriately taxed under that regime. We are therefore considering issuing anti-abuse rules that would deny the Section 245 Cap A deduction for distributions of earnings to the extent that the earnings avoid being taxed to any U.S. shareholder as a result of extraordinary transactions that trigger earnings and profits in a year that the stock of the relevant CFC is sold. I'm told that one of my predecessors at Treasury likened the issuance of anti-abuse rules to hunting geese in a fog. You periodically fire a shotgun up into the clouds, and eventually you may hear some squawking, and perhaps something will fall from the sky. I'm hoping we can be somewhat more precise than that, but I'm sure we'll hear some squawking. Nevertheless, we feel obligated to do all we can to prevent large-scale stripping of earnings out from under the U.S. taxing jurisdiction in ways that Congress never intended. We would welcome comments as to how we can do so effectively with appropriately targeted rules. I want to close my presentation by observing that the reform of the United States of its international tax rules has global significance. I spent the first 3 days of this week at the OECD meetings in Paris with my counterparts from G7 countries to discuss the future direction of the task force on the digital economy and what further multilateral tax discussion should take place to follow up on the BEPS initiatives. It is clear to me that U.S. tax reform is having a big influence on how these discussions will go forward. First, the enactment by the United States of the GILTI regime has been favorably commented upon by a number of countries. It is now appearing likely that there will be serious multilateral discussions as to whether all countries should agree to adopt some form of minimum tax for offshore income. The United States welcomes those discussions. Second, the enactment of the BEAT by the United States is being viewed as evidence that inbound anti-base erosion measures need to be renegotiated on a multilateral basis. Countries are not satisfied with relying solely on traditional transfer pricing principles. A consistent, mutually agreed multilateral approach to the problem is important to avoid double taxation. For these reasons, I believe that the reform of the U.S. international tax rules, which we are all working so hard to digest and to implement, will prove historic not only for the United States tax system, but for the future of the global tax system. The discussions at the OECD pursuing a long-term solution to the challenges faced by the international tax system are showing real promise. I believe that there will be a serious multilateral consideration of a comprehensive package of international tax reforms. This package will likely include both the mandatory minimum tax regime and inbound anti-base erosion rules that provide for exceptions from traditional permanent establishment and income allocation rules in appropriate circumstances. This package would be broadly applicable across industries. It would not be targeted solely at digital businesses. It would instead obviate the need for any special regimes targeted at digital businesses. These negotiations at the OECD are taking place while the EU is deciding whether to adopt a digital services tax. As I have reiterated many times in many places, the United States opposes any digital services tax. As an excise tax on gross revenues, it is bad tax policy. As drafted, it would be targeted to raise the overwhelming majority of its revenue from U.S.-based multinationals and would therefore be highly discriminatory. We therefore urge the EU not to adopt the digital services tax and to allow the OECD to continue to work towards a comprehensive, long-term solution to these issues, which addresses the broader range of challenges facing the international tax system, rather than unfairly targeting a single industry. With that, I'd be happy to entertain a few questions as time permits. Anyone? Yeah, perhaps just shout. Yeah, that'll work. I'm not sure I'm familiar with the specific paper you're referring to, but both the UK and the EU have been proposing a longer-term income tax-based solution that would create special PE rules and income allocation rules solely for digital presences based on a theory of sort of the value of user participation in a given market. The United States thinks that that approach is far too narrow, that it inappropriately focuses on a single industry, and that the problems faced by the international tax system are much broader than that. There are a whole variety of types of tax planning involving high-value intangibles outside of the digital industry that should be addressed. So while we oppose a particular regime targeting digital-only business models, we entertain enthusiastically the discussion of broader-based approaches to the more general issues facing the international tax regime. Again, we are, Mm-hmm. We fully intend to have proposed regs out under 245 Cap A this year, and with reliance language in those regulations, and have them in final form by June next year, so that people should have final guidance for their 2018 tax returns. And so I believe that fills the need. Well, the WTO is sort of issues, trade issues are out of my jurisdiction. They're the responsibility of the U.S. Trade Representative, Ambassador Lighthizer. So, I will not comment on potential WTO challenges. I will observe that next week the OECD Forum on Harmful Tax Practices meets, and on the agenda is a consideration of whether the FDII constitutes a harmful tax practice. We believe that it does not. We believe that properly viewed, the FDII in combination with the GILTI is designed to create tax neutrality in the choice of whether to conduct foreign market activities through a CFC or directly from a domestic corporation. And so we think that attempts to create greater tax neutrality is the opposite of a harmful tax practice, which tend to be designed to create specific tax incentives to locate operations one place or another. So we will be presenting that case in the Forum on Harmful Tax Practices next week. Or no, maybe it's the following week, the week of the 14th. And the discussion at the OECD will probably continue for over a schedule of a number of meetings, so not expecting any result of those deliberations this year, but we are in the process of defending the foreign-derived intangible income regime at the OECD. As far as I'm aware, there has not yet been any action filed under the WTO with respect to it. We are, yes, studying our alternatives under it and working closely with Joint Committee on Tax as they consider technical corrections. So we have not reached final decisions about the form of guidance, but we are grateful to the New York State Bar Association for flagging these issues, and we certainly are interested in further comments about how we can address them in an appropriately targeted manner.
Any other questions? Seeing none?
Thank you very much.
Thank you very much, Chip.